Please read the disclaimer first. Everything discussed on this channel is for educational and informational purposes only. Nothing here is financial advice. Always do your own research before making any investment decisions. Tomorrow could change everything for XRP and for the entire crypto market. And no, that is not clickbait. What is lining up right now is a combination of economic data, institutional movement, geopolitical tension, and a major legal decision that could send shockwaves across global markets. If you are holding XRP, trading crypto, or even watching from the sidelines, this is something you need to understand clearly. Hello, beautiful people. Shalom, moneymakers. Welcome back to We Are Cosmic, the channel where we cut through hype, ignore noise, and focus on logic, data, and real market mechanics. If you are new here, my name is Host Voice Implied, and on this channel we talk about finance, macroeconomics, and cryptocurrency from a professional analytical point of view. No promises of overnight riches, no emotional gambling, just real conversations about what is actually moving the market. We do not have time to waste today, because the market is not waiting for anyone. So let's get straight into it. The day started with fresh U.S. economic data, specifically initial jobless claims. The actual number came in at 208,000 compared to a forecast of 213,000 and the previous reading of 199,000. What does this mean in simple terms? Fewer people are losing jobs than expected. On the surface, that sounds positive, but markets don't always react emotionally. They react strategically. Strong labor data reduces urgency for rate cuts, and that can pressure risk assets like crypto in the short term, and that is exactly what we saw. As this data hit the market, we saw a small sell-off. XRP reacted as well. Price dropped sharply, touching levels around the mid-2 range before stabilizing. From a technical perspective, XRP briefly moved below key exponential moving averages on the lower timeframes. That understandably made some traders nervous. However, and this part is important, the daily chart still printed a buy signal. Price dropped into a key crossover zone and bounced, which tells us that buyers are still present. This is why context matters. One candle does not define a trend, one red move does not invalidate a larger structure, and tomorrow's events could easily overpower today's price action. Now here's where things get interesting. This is not just about charts. This is not just about XRP. This is about liquidity, confidence, and uncertainty. And uncertainty is the one thing markets hate the most. Tomorrow, we are facing multiple possible catalysts that could affect not just crypto, but stocks, bonds, and currencies globally. Some of these factors are already causing investors to de-risk slightly, and crypto usually feels that pressure first. XRP, being highly liquid and widely traded, often becomes an early indicator of that stress. At the same time, we are also seeing structural progress behind the scenes for XRP. New liquidity venues, infrastructure upgrades, and institutional-grade integrations. This creates a very interesting tension between short-term fear and long-term fundamentals. That is exactly why this moment matters. One of the most important headlines today is the fact that the first XRP spot trading pair has officially gone live on Hyperliquid through FXRP on Flare. This may sound technical, but let me explain why this matters in very simple terms. Liquidity is oxygen for any financial asset. The more places an asset can be traded spot to spot, the more efficient price discovery becomes. This also reduces reliance on a small number of centralized exchanges. For the first time, XRP spot liquidity is now directly accessible on Hyperliquid. That means traders, funds, and market makers now have another route to deploy capital into XRP without friction. Over time, this increases depth, tightens spreads, and reduces violent price manipulation. These things do not usually create instant pumps, but they build the foundation for stability and larger moves later. This is how mature markets grow, not through hype, but through plumbing. Now let's connect this to another extremely important development that flew under the radar for many retail investors. Amazon Web Services working with Ripple on an XRPL upgrade. According to reports, AWS is helping integrate Amazon Bedrock AI into the XRP ledger system. Again, this is not a meme headline. This is real enterprise-level infrastructure. Right now, one of the biggest operational bottlenecks for large-scale blockchain systems is log analysis. When something goes wrong or when performance needs to be audited, system logs can take days to analyze. With this integration, XRP ledger logs could be analyzed in minutes instead of days. That is a massive improvement. Why does this matter? Because institutions do not tolerate inefficiency. Banks, payment providers, and large financial systems require speed, transparency, and rapid diagnostics. If XRPL can offer faster issue resolution, better monitoring, and improved scalability, it becomes far more attractive as core financial infrastructure. This is how blockchains move from speculation to utility. Now, notice something very important here. While price is pulling back slightly, the network itself is becoming stronger. Liquidity routes are expanding, infrastructure is improving, enterprise-grade tools are being integrated. These are not signs of a dying asset. These are signs of a system being prepared for larger scale usage. However, as a responsible analyst, I also need to talk about risk, and this is where experience matters. We recently saw what happened with Zcash. After internal conflict and the resignation of its core development team, price dropped nearly 20% in just a few hours. That kind of move has nothing to do with charts. It is purely trust-based risk. When teams fracture, markets react instantly. So the question becomes, could something like this ever happen to Ripple or XRP? The honest answer is yes. It is always a possibility with any project. Teams can disagree, leadership can change, conflicts can happen. And that is why you must never blindly assume that any asset is immune to risk. What matters is governance structure, transparency, and long-term alignment. So far, Ripple has shown consistency. Leadership has remained stable, development has continued, partnerships have expanded. That does not mean risk is zero, but it does mean risk is managed better than most. This is why I always give you the good, the bad, and the ugly, not to scare you, but to prepare you. Because informed investors survive volatility. Emotional investors don't. As we move forward, keep this perspective in mind. Price reacts short-term, infrastructure builds long-term. When those two eventually align, that is when real moves happen. Now, infrastructure alone is not what is pressuring markets right now. There are much bigger forces at play. Geopolitics, legal uncertainty, and macro decisions are all converging at once. And that brings us to the real reason why tomorrow matters so much, not just for XRP, but for the entire financial system. Right now, the situation involving Iran is becoming more complicated by the day. Reports suggest that internet access and communications have been disrupted. When you hear about internet shutdowns, that is never a small issue. It usually signals internal instability, preparation for conflict, or attempts to control information flow. Markets pay attention to this because uncertainty at a geopolitical level can quickly turn into financial stress. There is also growing speculation that the United States could become more directly involved. Whether that happens or not, the mere possibility is enough to change investor behavior. When global tension rises, capital moves defensively. Investors reduce exposure to high-risk assets, increase cash positions, and wait for clarity. Crypto, being a high volatility asset class, is often the first thing to be trimmed. Now here's something most people don't think about. Countries under heavy sanctions often turn to alternative financial systems. Crypto becomes a tool, not always for investment, but for liquidity, hedging, or even strategic market actions. There has been discussion, including in previous videos, about whether governments that hold crypto could short markets or move liquidity strategically during periods of stress. This is not conspiracy, it is game theory. If a state actor needs liquidity or wants to apply pressure, crypto markets are fast, global, and liquid. That makes them useful and dangerous. This does not mean it is happening right now. But as analysts, we must acknowledge that geopolitical stress increases the probability of abnormal market behavior. That alone is enough to justify caution. Now let's zoom out. When geopolitical risk rises, traditional markets like stocks often take longer to react. They are buffered by trading halts, institutional procedures, and slower settlement systems. Crypto does not have those buffers. It trades 24/7. It reacts instantly. That is why crypto often sells off before the stock market shows any fear. This is not weakness. This is speed. So when you see crypto pulling back while equities are still near all-time highs, that does not mean crypto is broken. It means crypto is pricing in risk early. And right now, there is plenty of risk to price in. But geopolitics is only one side of the equation. The real pressure point, the event that could act as a trigger, is happening tomorrow. And it has nothing to do with Iran directly. It has everything to do with U.S. law, tariffs, and government finances. The U.S. Supreme Court is expected to issue a decision on Trump-era tariffs, and markets are already assigning a high probability that those tariffs could be ruled illegal under their current legal framework. Estimates suggest roughly a 76% probability of an unfavorable ruling. Now, why does this matter for crypto? Because tariffs are not just trade policy, they are revenue. If the court rules against the tariffs, two major issues arise immediately. First, tariffs that have already been collected may need to be refunded to importers. That means cash leaves the system. Government liquidity tightens. That is not bullish in the short term. Second, those tariffs were projected to reduce the U.S. deficit by trillions over the next decade. If that reduction disappears, fiscal pressure increases. More borrowing, more uncertainty, more volatility. Now, here's the paradox. Long-term, removing tariffs could ease inflation and increase the likelihood of interest rate cuts. That would be positive for risk assets like crypto. But short-term, uncertainty dominates. Markets hate not knowing what comes next. And when uncertainty rises, selling happens first. Questions are answered later. This is why we may be seeing XRP and the broader crypto market selling off slightly ahead of this decision. Traders reduce exposure, lock in profits, and wait for clarity. Tomorrow's ruling does not decide the future of crypto, but it absolutely can decide near-term direction. Yesterday, we saw something that caught a lot of attention. U.S. spot XRP ETFs recorded their first net outflow after a 36-day inflow streak. That alone sounds alarming to some people, but context is everything. First, understand this clearly. One red outflow day does not signal a trend reversal. It signals profit-taking and risk management. Many institutional investors come from the stock market. In traditional finance, a 10-20% move is considered excellent performance. When an asset like XRP moves aggressively over a short period, these investors do exactly what they are trained to do. They take profits. That does not mean they are bearish, it means they are disciplined. So when XRP rallied strongly over several days, it is completely logical that some ETF holders locked in gains, especially with uncertainty looming around tariffs, geopolitics, and macro policy. Reducing exposure temporarily is a rational move. This is why you saw that large red candle around the same time ETF outflows were reported. Price action and capital flow are deeply connected. When money stops coming in aggressively and some money leaves, price naturally pulls back. But here's what is important. The candle recovered. That tells us buyers stepped in. It tells us demand still exists. This was not panic selling. This was controlled distribution. Now let's address something most people overlook. ETF flows are not emotional. They are systematic. Institutions rebalance positions based on volatility, macro risk, and portfolio exposure. When uncertainty increases, allocations to high-risk assets like crypto are reduced, not eliminated. That is a huge difference. Crypto native traders often misinterpret this as weakness. In reality, it is professional risk adjustment. Another key point is liquidity cycles. When XRP ETFs were seeing inflows for 36 straight days, that liquidity had to come from somewhere. At some point, that cycle pauses, money rotates. That is how markets breathe. So instead of asking, why are institutions selling? The better question is, are they leaving permanently? And based on current data, the answer is no. Now let's connect this back to the broader market. Interestingly, while crypto has seen some selling pressure, the stock market remains close to all-time highs. That tells us something very important. Equity markets are not panicking yet. They are waiting. Crypto, once again, is reacting first. This supports the idea that what we are seeing is pre-event positioning, not fear-driven collapse. Traders are lightening exposure ahead of a known binary event, the Supreme Court decision, and preparing to re-enter once clarity returns. Remember this principle. Uncertainty creates sell-offs, clarity creates rallies. That is why tomorrow matters so much. If the ruling goes against the tariffs, markets may initially react negatively due to refunds, deficit concerns, and policy confusion. But once the dust settles, expectations for lower inflation and future rate cuts could become supportive for crypto. If the ruling supports the tariffs, uncertainty reduces and risk assets may breathe a sigh of relief. Either way, resolution matters more than the outcome itself. Now there is one final macro layer we need to talk about, and this one could shape the next cycle entirely. Former President Donald Trump has stated that he has already decided on the next Federal Reserve chair, even though the decision has not been publicly discussed yet. That alone is a powerful signal. Markets move on expectations, not announcements. Whoever that next Fed chair is, their stance on interest rates will matter immensely. Aggressive rate cuts would be highly supportive for risk assets, including crypto. Even signaling future cuts could trigger a preemptive market rally. This will not happen overnight. It could take months, but markets often move before policy changes actually occur. So when you combine ETF behavior, macro uncertainty, legal decisions, and future monetary policy expectations, you get a market that is cautious but not broken. Now that we've covered infrastructure, geopolitics, ETF flows, and macro pressure, it's time to talk about the most powerful force in any market, psychology. Price does not move just because of numbers. It moves because of human behavior reacting to uncertainty, fear, and expectations. Right now, the market is not scared. It is uncertain, and there is a big difference between the two. Fear creates panic. Uncertainty creates hesitation. When investors do not know what tomorrow's headline will be, they reduce exposure. They do not go all in. They do not make aggressive bets. They wait. That waiting phase often looks like selling, consolidation, or sideways movement. And that is exactly what we are seeing across crypto, including XRP. This is why I want you to understand something very clearly. Short-term sell-offs do not invalidate long-term narratives. They test conviction. They shake out weak hands. They reset leverage. Professional money understands this very well. Smart money does not chase green candles. Smart money builds positions during confusion. When everyone is arguing about headlines, professionals are analyzing probabilities. They are not asking, will this go up tomorrow? They are asking, is the risk to reward improving? And right now, despite all the noise, XRP's long-term structure remains intact. Let's connect this back to what we've discussed. Infrastructure is expanding. Liquidity routes are growing. Institutional products exist. Regulatory clarity around XRP has improved significantly compared to past cycles. These are not signs of a market that is falling apart. So why does price feel weak? Because liquidity is waiting for confirmation. Markets do not like binary events. Tariff rulings, geopolitical escalation, Fed leadership changes, these are not gradual developments. They are switch flips. And before a switch flips, money steps back. This is where many retail investors make mistakes. They confuse patience with danger. They see red candles and assume something is broken. In reality, the market is simply holding its breath. Another psychological trap is overreacting to comparisons. When people see the stock market near all-time highs while crypto pulls back, they assume crypto is underperforming. What they don't realize is that crypto often leads both up and down. It moves first, absorbs the shock, and stabilizes before other markets even notice. This has happened repeatedly in past cycles. Now let's talk about expectations. Some people expect XRP to move in a straight line up. That is not how markets work. Growth happens in waves: expansion, pullback, consolidation, continuation. If you remove pullbacks, you remove sustainability. Healthy markets correct, and corrections are not punishments. They are preparations. This is also where discipline matters. If you are over-leveraged, every pullback feels like the end. If you are positioned responsibly, pullbacks feel like noise. That is why I always emphasize education over prediction. I cannot tell you exactly what tomorrow's candle will look like. No one can. But I can tell you how to think about it. If uncertainty resolves, liquidity returns. If liquidity returns, price follows. If uncertainty escalates, markets may dip further. But dips without structural damage are not crashes. They are recalibrations. Now let's bring this home. The question you should not be asking is, should I panic? The better question is, has anything fundamentally changed? And as of right now, the answer is no. What we are seeing is a market reacting to temporary uncertainty, not permanent failure. When you strip away the noise, the headlines, and the emotions, what you are left with is a market standing at a crossroads. Not because crypto is weak, but because clarity is about to replace uncertainty. And that transition period is always uncomfortable. Right now, XRP is not reacting to a single event. It is responding to multiple forces converging at the same time. Economic data is influencing rate expectations. Geopolitical tension is increasing risk sensitivity. Legal decisions are creating policy uncertainty. Institutional investors are managing exposure. And yet, beneath all of this, infrastructure continues to improve. That combination tells a very important story. Short-term pressure does not erase long-term positioning. We've seen XRP expand into new liquidity venues with spot trading pairs going live. We've seen enterprise-level infrastructure upgrades with AWS involvement. We've seen regulated ETF products bring institutional capital into the ecosystem. These are not speculative signals. These are structural developments. At the same time, we've also seen profit-taking, cautious positioning, and temporary outflows. That is not weakness. That is market maturity. Healthy markets do not move straight up. They move in cycles. They test conviction. They force participants to make emotional decisions, and then they reward patience. Tomorrow's Supreme Court decision on tariffs is a perfect example of a short-term catalyst that can distort perception. No matter the outcome, markets will react first and think later. That initial reaction does not define the trend. What matters is how markets behave after clarity is restored. If tariffs are ruled against, the short-term reaction may be volatile. But over time, lower inflation pressure and increased probability of rate cuts could benefit risk assets like crypto. If tariffs remain, uncertainty decreases and markets may stabilize quickly. Either way, resolution is more powerful than speculation. Add to that the future implications of a new Federal Reserve chair, and you begin to see why smart money is patient right now. Monetary policy drives liquidity, liquidity drives asset prices, and crypto is one of the most liquidity-sensitive markets in the world. So here is the most important takeaway from this entire discussion. Do not let short-term uncertainty shake long-term understanding. If you are watching XRP every 5 minutes, every red candle will feel personal. If you zoom out and look at structure, development, and adoption, the picture becomes much clearer. This is not a time for emotional reactions. This is a time for awareness. That does not mean blind optimism. It means informed positioning. It means understanding risk without being controlled by it. As always, remember this. Everything discussed here is for educational and informational purposes only. This is not financial advice. Markets involve risk, and responsibility always lies with the individual. If you found value in this breakdown, make sure to support the channel. Smash the like button, subscribe to We Are Cosmic, and check the links in the description below if you want to go deeper into the research and tools we use. We are building a community here that values clarity over hype, patience over panic, and knowledge over noise. Thank you for watching. Stay grounded, stay curious, and I'll see you in the next one. We are Cosmic.